Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, November 6, 2025, we're really taking a deep dive into, well, a global financial world that feels full of conflicting signals, doesn't it? For you, the listener, it means trying to get your head around two big things at once. This incredible euphoria around AI stocks pushing valuations way up, and then, these pretty serious fundamental warnings, red flags popping up. Plus, there's this massive legal uncertainty from that Supreme Court tariff case, adding another layer of, well, chaos. It's a lot to sort through, and we're going to try and make sense of what really counts today.
Right, that's the plan. We've gone through a big stack of sources this morning, pulling key stuff from Reuters, Bloomberg, CNBC, Yahoo Finance, trying to get you that clarity. So we'll map out how much the market really relies on just a few tech giants. We'll drill down into the government's argument at the Supreme Court, which seems surprisingly weak, frankly. And then we'll look at the real-world impacts of AI stuff, like your energy bill and potentially jobs.
Okay, let's start there with that concentration risk. It seems pretty stark. The numbers from S&P Dow Jones indices reported by Reuters are probably the best place to kick off. The tech sector alone, it's now about 36% of the S&P 500. Now, we've talked about concentration before, but 36%, that's actually higher than the peak of the dot-com bubble 25 years back.
Yeah.
That alone makes you pause, right?
It absolutely should. And, as startling as 36% sounds, it doesn't even paint the full picture, because that's just the companies formerly called technology. If you add in the other huge players that are basically tech leaders, think Alphabet, Amazon, Tesla, Meta, well, analysts say that whole group makes up nearly half the S&P 500 benchmark, almost 50%.
Half. Wow. So nearly half the market's wealth tied up in maybe 10 companies, all riding this AI wave. What kind of vulnerability does that create?
Well, Walter Todd at Greenwood Capital put it pretty well. He basically said that concentration means any hiccup, any little problem with AI's future, or even just weakness in one big name. You mentioned Palantir, NVIDIA seeing a dip recently. It doesn't just hit that one stock. It becomes an immediate systemic risk for the whole market. Matt Maley from Miller Tabak, he said the indexes can only climb so high if tech pulls back. There's nowhere else to really hide.
Okay, so concentration risk is high. And if that wasn't enough, let's look at the valuations themselves, those traditional metrics. The S&P 500's forward price to earnings ratio, basically what people are paying now for future expected earnings, it's around 23 times. That's quite a bit higher than the 10-year average of, 18.8?
That's significantly higher.
Yeah.
And the tech sector itself, it's sprinting even further ahead. Its forward PE is sitting around 32 times, which just crushes its own decade average of about 22.2. But what Bloomberg highlighted as maybe the most compelling warning right now, that's the Buffett indicator.
Ah, right. The market cap versus GDP. Remind listeners, why is that sometimes seen as a better gauge than PE, especially when rates have been so low?
That's the key point. Standard PEs can get a bit skewed when interest rates are super low, right? Makes future money seem worth more today. The Buffett indicator, though, comparing the total value of the stock market to the size of the actual economy, the GDP, it kind of cuts through that noise. And right now, that indicator has shot past its pandemic era record high. Barclays strategists are saying this level signals potential overvaluation, maybe even excessive euphoria. It's flashing the kind of warning that often comes before a big correction.
Excessive euphoria. That sounds ominous. But let's bring in the other side of the argument. This isn't exactly like the dot-com crash, is it? There's a strong counterpoint.
Absolutely. We have to address that. The big difference, according to analysts like Scott Wren at Wells Fargo, is pretty fundamental. These aren't just ideas on paper this time. The AI leaders today, they're real companies with real cash flows. The profits are genuine, they're solid. In fact, tech profits are expected to make up about 25% of all S&P 500 earnings in the third quarter.
Okay, so the profits are real, the companies are doing well. So why should we still be worried about the Buffett indicator being so high? Isn't it possible this is just, the new reality where the best companies naturally get a bigger slice?
And that's the core debate, isn't it? We care because even real profits can't really justify infinite valuations forever. It means the market isn't necessarily built on pure fantasy, like some dot-coms were, but it is priced for perfection, as they say. There's basically no room for error. Any missed earnings number, any geopolitical shock, any unexpected regulation, and those high prices could deflate really, really fast.
Right, that makes sense. Priced for perfection. And that context makes Jim Cramer's recent advice feel pretty practical. CNBC highlighted it after that little dip in AI names.
It does. His advice, after seeing stocks like Palantir dip a bit, was basically use those dips as a chance to buy. But and this is key, do it gradually. Don't just jump in with both feet. And you saw how quickly names like AMD and Micron bounced back this week. It shows the big investors, the institutions, are definitely watching for those buy-the-dip moments in the leaders.
Okay, let's shift gears now from market sentiment to policy and legal battles. The Supreme Court heard arguments this week on that big case challenging President Trump's blanket tariffs, Learning Resources, Inc. v. Trump. This could really shake things up.
Yeah, this is a major challenge to presidential power under that 1977 Emergency Economic Powers Act. And the government's argument, laid out by the Solicitor General D. John Sauer, well, Yahoo Finance reported it as pretty audacious. They argued the duties are clearly regulatory tariffs, not taxes. And the billions coming in each month, that's only incidental to the policy goal.
Incidental. How do they square that with the president himself constantly talking about the huge revenue? He's projected, what, $4 trillion in deficit reduction from tariffs, even floated ending the income tax because of it. How did the Solicitor General try to bridge that gap for the justices? What was the actual legal point?
The legal distinction they tried to draw was all about intent. The government's line was, the purpose is to regulate trade, protect U.S. industry that's foreign policy. It's not primarily about raising money, which is Congress's job, the power to tax. But the justices seem pretty skeptical. Chief Justice Roberts directly questioned if the president's foreign policy power could just trump that basic power of Congress to tax.
Yeah, and Justice Sotomayor sounded even more direct. She said, I just don't understand this argument. So you want to say tariffs are not taxes, but that's exactly what they are. I mean, it feels like common sense, right? A huge fee at the border is a tax.
It certainly seems that way on the surface. And it wasn't just the liberal justices. Justice Amy Coney Barrett, a conservative, also questioned the scope, asking why tariffs were needed on countries like Spain and France if the goal was protecting the U.S. industrial base. The overall feeling in the courtroom seemed to be real hesitation about giving the executive that much unchecked power over trade.
So after that skeptical reception, what was the immediate market reaction? Did things move?
Equity futures didn't jump around much, no. Suggests traders are maybe waiting for the actual ruling, but the prediction markets, they reacted quickly. CNBC noted polymarket traders now only see about a 25% chance the tariffs will survive this legal challenge. That's a big drop from before the hearing.
And even if the administration loses this particular case, the uncertainty doesn't just vanish, does it?
Not at all. If the government has to refund billions in collected duties, Wharf Research thinks that could actually nudge Treasury yields higher, potentially pressuring stocks. But maybe more importantly, even if the Supreme Court strikes down the use of this specific law, the president could likely try to use other executive powers to put similar tariffs back in place. So for businesses trying to plan, that unpredictability is pretty much guaranteed to continue no matter how this ruling comes down.
Okay, moving away from Washington gridlock, let's look at the physical side of this AI boom, the actual infrastructure. All that computing power needs incredible amounts of energy. And natural gas seems to be becoming the quick fix, especially for powering data centers off the main grid.
Yeah, this is a massive story shaking out in the energy world. Yahoo Finance was highlighting Comstock Resources, a Texas gas producer. They're sitting on what their CEO calls the holy grail of supply on the Western Haynesville Basin. Jerry Jones, the Dallas Cowboys owner, is a big investor, and he thinks that land holds something like $100 billion worth of natural gas.
$100 billion worth. That really underscores how real these energy needs are. The existing power grid just can't keep up with connecting these huge new data centers fast enough.
Exactly. So developers are increasingly looking at behind-the-meter options, basically building their own mini power plants, often using natural gas turbines right there at the data center site.
And this massive power demand, it's already hitting consumers, right?
It is, directly. CNN reported residential electricity prices. They've spiked 21% in New Jersey and 13% in Virginia year over year. Part of that increase is being driven by building all these power-hungry data centers. Virginia is kind of ground zero for the industry, so that's a real cost hitting your wallet, linked straight back to the AI boom.
Yeah, I'm actually near one of those big data center clusters in Virginia. Hearing that 13% jump is partly because of them.
Yeah.
Makes it feel a lot less abstract than, say, a PE ratio. That's real money out of people's pockets.
Exactly. And while AI is pushing up external costs like your power bill, companies are also using it internally to cut their own costs, especially labor costs. We saw Bank of America lay this out pretty clearly at their investor day.
Right. BofA wants a big push on efficiency. They're aiming to get their efficiency ratio, which is basically their costs compared to their income, down from 64% to somewhere between 55% and 59%. How are they planning to pull that off?
A lot of it relies on AI. They're using their own tech, like their chatbot Erica, to handle more routine customer queries, cut down call center traffic, and even assist their bankers. But this drive for efficiency, it is pretty serious implications for jobs on Wall Street. Compensation consultants are now forecasting that overall headcount could drop by 10%, maybe even 20% across the financial industry in the next 3 to 5 years.
Hold on, up to 20% fewer jobs? That's a massive potential shift for how banking and wealth management works. Are we just talking about replacing entry-level roles, or is this hitting more senior people too?
It looks pretty fundamental. These AI tools are getting better and better at crunching huge amounts of data, synthesizing information. Tasks that used to need experienced, highly paid analysts. So while, yes, some junior roles might go, the feeling is the bigger impact could be on those middle management and analytical jobs. It points towards a much leaner, tech-driven workforce across the whole sector.
Wow. Okay, so while Wall Street braces for potential cuts, we're seeing this really interesting global shift happening with high-skilled jobs moving towards places like India.
Yeah, the dynamic is really changing there. CNBC had a report on India's Global Capability Centers, GCCs. These aren't just back offices anymore doing basic processing. They're being called leadership hubs. They're co-owning innovation, developing intellectual property. Big names like Vanguard, Maersk, even Lowe's. They're actually moving VP-level roles, global function heads, to India to run major parts of the business worldwide. It shows a real shift in the kind of global talent they're tapping into.
That is a significant change, a sign of real maturity in those centers. Now, contrasting that success, what's the story with Chinese tech, especially in areas like autonomous driving? Things seem a bit rockier there.
A bit, yeah. Two Chinese autonomous driving firms, Pony.ai and WeRide, they recently debuted in Hong Kong, and, well, they slumped.
Yeah.
Down 12%, 13% respectively right out of the gate. Both are already listed over here in the U.S. And Sino Auto Insights suggests this weak Hong Kong debut is really tied to all that ongoing regulatory uncertainty in the U.S. about Chinese tech, especially in connected cars. So these Hong Kong listings, they look more like risk mitigation, a way to tap into Asian capital, focus expansion maybe more on Asia, the Middle East, Europe, rather than navigating the tougher path into Western markets right now.
Got it. Okay, finally, let's just quickly touch on the latest macro picture before we wrap up, starting with the U.S. jobs market.
Right, the ADP private payroll data for October came in. It showed a small gain, about 42,000 jobs, which did break that recent streak of job losses. But even though it beat expectations slightly, it still adds to this overall picture of a, softening labor market. And that view that the job market is cooling, potentially leading to Fed rate cuts down the line, that was enough to help push gold prices back over $4,000 an ounce, according to Bloomberg. It supports that idea of maybe a less aggressive Fed going forward.
And across the Atlantic, the Bank of England is meeting today, right? What's the expectation there?
Yeah, the overwhelming consensus, reported by CNBC, is that the BOE will hold its main interest rate steady at 4%. They seem inclined to pause, wait and see what's in the UK's autumn budget later this month, on November 26th. With inflation falling, it was 3.8% in September, and the UK labor market also showing signs of softening. Most analysts think a rate cut is coming. Maybe not immediately, but likely no later than February 2026, possibly even as soon as December this year. They just want to see the government's spending plans first. So pulling all this together from our deep dive today, you really see global finance wrestling with these huge opposing forces, don't you? You've got these extreme valuations in AI, but they're being somewhat supported, or at least counterbalanced, by genuinely strong corporate earnings from those same tech leaders. And then layered on top, you have these high-stakes political and legal fights like the tariff case, throwing massive uncertainty into the mix for global trade. It's a real blend of volatility and underlying resilience right now.
It really is. And maybe the final thought for you, the listener, as you try to figure out this AI-driven market, think about that complex trade-off we just unpacked. You have these huge gains flowing to big tech, to resource companies like Comstock. But at the same time, there are these hidden or maybe not so hidden costs for everyday people. It's showing up in rising electricity bills in places like Virginia and New Jersey. It's fueling anxiety about job displacement as Wall Street talks about significant cuts. So the question to mull over is, what's the true full cost of all this incredible innovation? And who ultimately is footing the bill for big tech's rapid rise? We'll see you all tomorrow morning with new headlines from major financial magazines.